In the previous lesson, we discussed the different option pricing components. Let's turn to the concept of extrinsic versus intrinsic value. Options consist of both intrinsic and extrinsic value. Out-of-the-money options only consist of extrinsic value. Intrinsic value is the real, tangible value of an option, representing the profit an investor would realize if they exercise the option immediately. It's the difference between the stock's current price and the option's strike price. Extrinsic value includes other factors such as time value and implied volatility. It represents the additional amount investors are willing to pay for the possibility that the option may become profitable due to these external factors. Intrinsic value is the difference between the strike price of the options and the current price of the underlying asset. It is the portion of the option's price that is not lost due to the passage of time. So here's the call option intrinsic versus the put option intrinsic value. The intrinsic value of a call option can be calculated as the underlying asset price minus the call strike price. Let's say ABC Corporation stock is trading at $105 and a $100 call option is trading for $7. This call option has intrinsic value of $5 calculated at 105 minus 100, and the remaining $2 is time value or extrinsic value. For a put option, intrinsic value is calculated as the put strike minus the price of the underlying asset. In our ABC example, a put with a strike price of 110 would have a $5 intrinsic value, 110 minus 105, the price of the underlying, and a put with a strike price of 95 would have zero intrinsic value and be made up entirely of extrinsic or time value. Right now, it's important to quickly revisit and bring up the concept of moneyness. Moneyness is a description of a derivative such as an option relating to its strike price to the price of its underlying asset. The out-of-the-money and in-the-money status affect the option premium. At expiration, an out-of-the-money option becomes worthless, while an in-the-money option has only intrinsic value. Now let's cover extrinsic value. Extrinsic value consists of time value and implied volatility, which is sometimes factored into time value, but I've separated it here for learning purposes. The time value of an option is the portion of its price that exceeds its intrinsic value. Options are depreciating assets, which means as time goes by, they lose value, all else being equal, of course. As time gets closer and closer to expiration, the time value decreases, negatively affecting the option price. And this is why options are called depreciating assets. The value is negatively correlated to the price of the option. The longer in time until expiration, the greater the time value. Time value represents the amount you are prepared to pay for the possibility of the market moving in your favor during the life of the option. Time value will vary between in-the-money, at-the-money, and out-of-the-money options, and is highest for at-the-money options. Out-of-the-money options are comprised entirely of time value. Deep-in-the-money options will be made mostly intrinsic value, and they will have very little time value. As time draws closer to expiration, the chances of a favorable movement in the underlying asset declines, and therefore the time value declines. The erosion of this time value is called time decay. Time decay picks up speed as expiration approaches, depending on whether you're at the money, out of the money, or in the money. And some of you may have seen a similar chart to this chart here. Another component of extrinsic value is implied volatility. Implied volatility reflects the market's expectation of the future volatility of the underlying asset. Implied volatility is positively correlated to the price of the option. As implied volatility increases, so does the price of the option. And you can see this graph here represents the implied volatility correlation to the price of the option. As you can see, as the implied volatility increases from left to right, the option price also rises, depicted by the upward sloping curve. This graph represents the general idea that higher IV, implied volatility, typically leads to higher option prices, underlining the positive correlation between these two variables. It's important to remember that this chart is a simplified representation. In real market scenarios, the relationship between IV and option price is influenced by other factors, such as the underlying asset's price movements, time decay, and interest rates. So again, here's another way to look at the positive correlation between implied volatility and option premium or option prices. Options are made up of both intrinsic and extrinsic value. Intrinsic value is the real, tangible value of the option, representing the profit an investor would realize if they exercise the option immediately. It's the difference between the stock's current price and the option's strike price. Extrinsic value represents the additional amount investors are willing to pay for the possibility that the option may become profitable due to factors like time and implied volatility. The option pricing lesson summary. Option pricing is akin to how insurance companies price policies, including risk assessment, policy duration, and premium. Complex mathematical formulas like the Black-Scholes model are used to set option prices based on several components. Options are made up of intrinsic and extrinsic value. Options are depreciating assets, which means as time goes by, they lose value, all else being equal, of course. We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieved my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.